Welcome back, my friends. I know that maybe you expected another video about big tech week earnings and maybe layoffs. Don't worry. It seems that there are many more of those to come, given the weakness of earnings season. But what about the rest of the economy? And what about cars? And what about Carvana? Carvana has been weakening financially for a few quarters now. And they have never been profitable. Sounds like the situation with a lot of tech unicorns, doesn't it? If you follow this channel, you already know that Carvana reported a disastrous Q3. And it is questionable how many of these disastrous quarters they still have in them. Carvana could run out of cash if the next few quarters are like Q3. Now, we are hearing that Carvana's creditors are basically ganging up. Carvana's largest creditors have signed a deal that binds them to act together in bankruptcy negotiations. Carvana stock fell by more than 40% when this news hit Wall Street. The agreement is said to include creditors that hold around $4 billion of Carvana's unsecured debt. And that $4 billion is only about 70% of the total unsecured debt outstanding. Carvana stock trading below $5 a share today. Carvana first went public in 2017. So, what is the real future of Carvana? What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Shares of Carvana cratered by more than 40% today. News that largest creditors signed a deal with each other hit Wall Street today. The agreement binds them to act together in negotiations with Carvana. Carvana's creditors include some very big names. Apollo Global Management. Pacific Investment Management, also known as PIMCO. The big holders have about $4 billion of Carvana's unsecured debt. The agreement is for at least 3 months. In theory, this type of agreement is a way to streamline negotiations. Typically, this would be for new financing or a debt restructuring. The idea is that the agreement would prevent fights between the various creditors. Restructuring of Carvana's unsecured debt could prove to be complicated in the current macroeconomic environment. Bankruptcy is becoming more likely for Carvana, said Wedbush analyst Seth Basham. Basham downgraded Carvana shares to underperform from neutral. He also cut his price target to $1 from $9 per share. That says a lot right there. The creditor deal signals that Carvana may have initiated debt restructuring negotiations with bondholders, said J.P. Morgan. But the possibility of imminent bankruptcy filing seems low, J.P. Morgan continued. We believe CVNA has enough cushion through short-term revolvers to get through till end of 2023, said J.P. Morgan analyst Rajat Gupta. A severe recession could accelerate this by 1 to 2 quarters, Gupta continued in a note. Not surprisingly, no comments were forthcoming. Not from Carvana. Not from Apollo. Not from PIMCO. Stock exchanges briefly halted trading in Carvana stock this morning. The halt was triggered when shares fell below $5 for the first time since the company went public in 2017. Then the trading halt was lifted and the stock fell below $4 a share. Shares in Carvana are down by more than 97% so far in 2022. You may already know that Carvana stock peaked at $376.83 per share on August 10, 2021. Carvana has received downgrade after downgrade from many Wall Street analysts. Carvana had a disastrous Q3 earnings call. On top of that, management guided to an even worse Q4. Carvana grew exponentially during the coronavirus pandemic. At that time, car shoppers shifted to online purchasing, even for cars. It was seen as safer than visiting a dealership in person. Carvana also promoted hassle-free buying and selling of used vehicles from the comfort of home. But Carvana did not have enough cars to meet the surge in consumer demand. Nor did it have the right facilities and workers to process the vehicles that it did have in stock. So then Carvana bought car auction company Adisa from Car Global. Carvana also bought a record number of vehicles at what turned out to be sky-high prices. That government stimulus during the pandemic caused inflation to rage almost everywhere. The Federal Reserve responded by aggressively raising interest rates. That caused car buying demand to slow dramatically. On top of that, fears of a recession set in. That made car buyers cautious and slowed Carvana's sales. Carvana could not react fast enough to the rapidly changing macroeconomic environment. So the company repeatedly borrowed money to cover its losses and various growth initiatives. That included the $2.2 billion acquisition of car auction company Adisa. Last week, Bank of America analyst Nat Schindler downgraded Carvana stock to neutral. The company badly needs more liquidity as it struggles to turn profitable, Schindler said. Carvana is likely to run out of cash by the end of 2023, Schindler continued. There is no indication yet of a potential cash infusion, Schindler also noted. Morgan Stanley analyst Adam Jonas pulled his rating and price target for Carvana stock. Jonas cited a number of factors: deterioration in the used car market, sky-high debt, and a volatile funding environment. Jonas also said that Carvana stock could be worth as little as $1 per share. If you recall from a little over a month ago, Carvana missed Wall Street's top and bottom line estimates for Q3. The future outlook for used car demand is softening significantly. Car pricing and profits soared during the coronavirus pandemic. But that seems to be coming to an abrupt end. Investment bank Morgan Stanley pulled its rating and price target on Carvana and will not even give another target. That is a bad sign when that happens. Morgan Stanley analyst Adam Jonas said that the used car market is deteriorating, and that unprofitable companies face a volatile funding environment. While the company is continuing to pursue cost-cutting actions, we believe a deterioration in the used car market combined with a volatile interest rate, funding environment, Jones wrote in a note to investors. Bonds trading at 20% yield add material risk to the outlook, contributing to a wide range of outcomes, Jones continued in the note. During the pandemic, pricing and profits of used vehicles have skyrocketed. That is because car buyers who could not find or afford to purchase a new vehicle decide to buy a used car or truck. Inventories of new vehicles were pretty sparse during the coronavirus pandemic. That was largely because of supply chain issues, not least of which was a global shortage of semiconductor chips. Nevertheless, rising interest rates, inflation and recessionary fears have basically cornered consumers into paying these record prices. Large franchised new and used vehicle dealers such as Lithia Motors and AutoNation warned of softening in the used vehicle market when recently reporting their third quarter results, Jones added. Next year will be a difficult one for Carvana, said Carvana CEO and co-founder Ernie Garcia. A normalization of the used vehicle industry from its inflated levels and increasing interest rates, among other factors, will hurt Carvana, Garcia continued. Cars are an expensive, discretionary, often financed purchase that inflated much more than other goods in the economy over the last couple years, Garcia also said. And it is clearly having an impact on people's purchasing decisions, he added. The end of Q3 is basically the most unaffordable point ever for customers who finance a vehicle purchase, said Garcia. Basically, all financial numbers of the Carvana's operations were worse in Q3 as compared to Q3 of last year. If you were watching the various public company earnings being reported, you already know what is going on. It is fair to say that Q3 earnings were weak or weakening in most companies, aside from oil companies. And, you know the financial and economic narrative of the times. Inflation is raging in most parts of the world. Central banks are aggressively raising interest rates in order to tame inflation. Consumers' budgets are getting tighter because of having to spend more on gas and food. So, consumer discretionary spending is weakening. This year, it is clear that Wall Street analysts are valuing profitability over prospective growth. As a result, unprofitable tech companies' shares are getting punished. It seems that the day of reckoning for tech unicorns has arrived. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.